Hi, Jim Gore from THOR Wealth Management. Well, we're in a bear market and people say, where do we go from here? And so what we look at, first of all, is our proprietary index, which is the THORdex that we create here at our shop. And if it's over 80, that's when you want to be careful about adding to equities, because the average annual rate of return on the S&P 500 over the next 10 years is less than 2%. However, if it's 20 or below, you really want to add equities into your portfolio, because that's a time that things are very cheap in the market. So where are we right now? Right now, we're at 48. So the THORdex is at the midpoint. It's basically saying that the market is not expensive, nor is it cheap, and it could go either way from here. And there really hasn't been that much movement in the last 3 months. Well, so what do we do from here? With the THORdex being at the midpoint, we have to listen to what the Federal Reserve is telling us. And they've been saying it since early February, that they want to see inflation come down. And the biggest part of that is seeing the unemployment rate actually go up. So let's look at where the unemployment rate is right now. So even with the Fed raising interest rates, we see that the unemployment rate is still exceptionally low. And because of that, the Federal Reserve is going to keep interest rates higher for longer. And they've been telling us this. This is not a black swan event. This is very open. If anything, it's a white swan. We can all see it in front of us. They're telling us we're going to keep interest rates higher for longer. And part of that is because of what happened in 1976. They cut interest rates after we had a bout of inflation in 73, 74, 75, cut interest rates in 76. And what happened? We had higher inflation in the late 70s. They see that and they don't want to make that mistake again. They want to quash inflation and bring unemployment rate up. So unemployment rate is low, but that's one part of employment. You have to also look at the job openings. Job openings have come down. That's good news. Bad news is it's still over 10 million job openings today. And it's very easy for people to go out and get new jobs today. You can go anywhere. I was just at an industrial park here in Cincinnati, and literally 7, 8 places had signs up that they were hiring technicians. So with all these job openings, this is going to cause inflation higher because of higher wages. So because the Federal Reserve is raising interest rates, we have to sit there and say, well, wait, this is a bear market like what we had back in 2000, 2002, 2008, and 2009. The Fed's raising interest rates. What did they do in that time period? Actually, the last time they raised interest rates in the 2000 era was January of 2000, and they were actually cutting it in 2001 and 2002 while the market continued lower. What happened in 2008? They didn't raise interest rates. Actually, they started cutting rates back in October of 2007, and they were cutting interest rates throughout 2008. So this is something that's a little bit different, where the Fed is going to raise interest rates from here in a bear market, which we have not seen in a while. So this is something that is different, and this is why the market can go a little bit lower from here. So one way to look at this is what's the possibilities of things that could happen. And I'm going to go back to, we did a market update back in December 16th of 21 on the ARK funds. This is the ARKK Innovation Fund with Kathy Woods that had a lot of press, and still she's on CNBC, even though her fund has collapsed. And then we did one about a month and a half later on January 27th of 22. And this is what this chart comes from. So this is on January 27th. We showed this chart. The ARK fund at that time was selling at $70 a share. And we were saying, what's the next stopping point? The next stopping point was 47, and the low could be 34 or 35. Then the next stop after that would be $20 a share. Can we get to that level? Well, I had some people say, Jim, you're crazy. It's not going to go down to 35 bucks a share. Let's see what has happened since January 27th of this year. So I updated this chart, and you can see that now we are in that range that occurred the first and second band. We fell to below 48. And right now, even with today's market being up the last Monday and Tuesday of this week, ARK is at $40 a share. It's right at the midpoint of that range. The thing is, if it breaks down below 33 or 34, the next stop is $20 a share, and that's a loss from here of 42%. So this is what could happen with interest rates rising. And this is why, with the market being fairly valued, if you will, you have to look at the risk of what the Federal Reserve is doing. And because of that risk, you still want to be cautious about putting money to work in the equity market. We do have other indicators on the fixed income side that's saying get a little bit longer in the fixed income market. But this is a time that you definitely don't want to load up the truck, because the Fed is raising interest rates, and we don't see any indication that they're going to stop that anytime soon based on all the things that they've been telling us for the last 9 months. If you have any questions or concerns, as always, reach out to us at THOR Wealth Management or give us a call. Take care and talk to you in a couple weeks.